Welcome to the Better Off Bonus Call of the Week. We're sponsored by Betterment, the largest independent online financial advisor. Remember, you've got 2 chances every week to get on the air. We do our Better Off Bonus Call of the Week. We drop that on Tuesdays. On Thursdays, we've got our long interview segment, but we follow it with a question from one of you. If you'd like to get in touch, just shoot us an email. Ask Jill at betteroffpodcast.com. So today, we've got Matt from Pennsylvania. Hey, Matt, welcome to Better Off. What can we do for you?
Well, I'm looking for a little advice. My wife and I were 37. We got 4 kids.
4 kids?
I know.
2 wasn't enough? You got to do 4 college educations now?
You got it.
Oh, brother. You're a glutton. Okay. How old are the kids?
They are young still, which is good. They are 8, 6, 4, and we have a 6-month-old.
Oh, my God. When's the last time you got a good night's sleep? Tell the truth. Tell the truth.
I would say that was probably about 2007.
At least you're honest about it.
Yeah.
Oh, brother. Okay. 8, 6, 4, and 6 months. You are really awesome. So good for you. So you're both 37. Are you both working, or what's happening here income-wise?
So we both work. My wife works part-time but full-time at home. I have to make sure I say that.
Yes, of course.
But we're doing well. We make around $250,000 a year.
Mm-hmm.
We are maxing out our retirement.
Great.
We have a very good matching fund, so that even helps even more.
That's good.
We have an emergency fund of about 3-4 months.
Mm-hmm.
But my main issue is that we still have some debt, and I'm thinking about 529s, and I just don't know which route to go.
Okay. All right. So let's talk a little bit about the debt. A house, a loan, maybe a mortgage in there?
We do have a mortgage.
Okay. What's the house worth?
The house is worth about $475.
Okay. And the mortgage is how much?
We owe about $310 on it.
Okay. And the rate on that mortgage?
It's 2.75%.
Holy smokes.
I know.
What's the term?
So it's the Penn Fed 5.
Oh,
5.
Okay. So it's an adjustable rate?
So it will reset in 2019.
Interesting. That's interesting. Okay, hold on. We're getting there. Any other debt associated with the house? A second loan, an equity loan, or anything like that?
We do have a HELOC for about $30K on it.
Is that drawn down, that $30K? In other words, is it available, or have you actually borrowed the $30,000?
Oh, I'm sorry. So available is about 60, and we have about 30.
Okay, got it. Very good. Very good. And that's just like a LIBOR plus something?
That's right.
Okay.
Right now it's at about 4%.
All right. That's not terrible. Tell me about any other debt, credit card debt?
With no credit card.
All right. Auto loans?
No auto loans.
What else? Anything else?
We have student loans.
Oh, look at how the voice goes down. It's almost like I feel like a priest in this moment. I don't know what a priest feels like, okay? But I'm just going to tell you, this is what a Jewish girl as close to a priest as you get, is it when people admit to me, like, well, I actually still have some debt. But it's student loan debt, Like, I wouldn't go crazy. What is outstanding for you guys?
So we have about $50,000 between the two of us in student loan debt.
Ooh, it's not terrible. I mean, you make $250,000 a year. So what's the... I'm sure you have a couple of different loans there, but what would you say is the average interest rate on the student loans?
Surprisingly enough, when we got them, we both replied, and they're at the same rate, and they are at 3%.
Oh, well, that's not bad. That's pretty good.
Yeah, because it's been so low, I haven't been paying it off as aggressively as I maybe originally thought I was going to.
Mm-hmm. Okay, well, let's go back for a second, though. So on the $250,000 a year, you're both maxing out retirement, right?
Yes.
Is there any money? But you got 4 kids. Is there any money left over when you pay all your bills and stuff?
We do, and we have roughly about $2K a month that we end up saving.
Mm-hmm. Interesting. Okay. So the reason I asked that question is not just because I want to give you a gold star, which I am going to give you a gold star for saving the $2K, but it also tells me that you can afford a higher mortgage payment if we were going to lock in your mortgage right now, correct?
Correct.
Okay. This is a very interesting case. Like many people, you took advantage of really low interest rates, right? You had that adjustable rate mortgage, which is currently 2.75%, but it's going to adjust higher in the next couple of years, correct?
That's correct.
Okay. So what I think makes a lot of sense this minute, and the reason why I asked you is, about the cash flow is that I just want to make sure that you could actually afford this, is that we're going to probably have to lock you into a fixed rate mortgage. Is this a house that you want to stay in? I should have asked that first, before we lock you in.
We think so. Our fourth one was not planned, and it is getting a little bit tight in space, but we do have 4 bedrooms. So we're thinking that we're going to most likely stay here for the long term.
Stick it out, man. Come on.
Yeah, I know.
Don't be messing around here, for goodness sakes. All right. So you've got it's a $475,000 house, $310 outstanding. You've got your emergency reserve. There's no immediate need for extra money. So I'm thinking that you're going to have to look. You're probably going to be looking at let's say a $350,000, because you roll the refi costs into the loan. So you're going to look at a $350,000 loan, and you're going to shop around, and you're going to get a 30-year fixed rate, and your payment's going to go up every month. And I'm sorry to tell you that, but that's just what's going to happen. And I think that is really the most prudent thing to do. If you told me you were absolutely going to move in the next couple of years, then we wouldn't fix it. Just kind of roll the dice, and that's that, right?
Right. Sure.
It's going to feel like a lot. It's going to be a difference for you guys, but you thankfully can afford it. And in my mind, the best thing that you can do is to fix that rate. Go get yourself a mortgage broker. Start comparing. Maybe does your Penn Fed, will they convert you into a 30-year fixed from this current loan, or will you have to rewrite a whole new loan?
That's a good question. I should give them a call to ask them that, because I know they do have very good rates right now on their 30-year fix, and I'm sure they would hate to lose me as a customer. So maybe they could. Maybe they would.
I think it's certainly worth, at the very least, checking out whether you can do it, because
Sure.
I think they'd rather keep the business, and maybe it just might be, maybe you'll get a better deal. I don't know. But of course, check other sources. And at that point, what's your payment right now?
So the payment for the for my primary is it ends up being about $1,350 a month.
And then, do you just pay interest on the home equity line?
No, we've been throwing we've been putting about $1,000 towards the HELOC, and then we were putting about $1,000 towards our student loans per month. And then baby number 4 happened, and I thought, maybe I should be thinking about $529.
You can think about it all you want, but I'm taking you off the hook. You don't have to do anything about it right now.
Okay.
I think.
And then my other thought was, should I pay down all of my debt except for the mortgage before it resets, which would roughly be about 30 months from now. So I could pretty much knock out all of the debt except for the mortgage within the time of the next reset. And the max the reset would go to would be 4.75%, and the loan amount at that point would be at $290.
Yeah, but then I got to refi that, right?
Technically, yes. Yeah.
And I don't know. That's such a roll of the dice.
I know.
So, okay, I'm going to just give it to you straight, man. I am a wimp.
Please.
I am a wimp, okay? I don't like this kind of risk, because this is not the kind of risk that I can actually figure out how to mitigate, right? When you think about risk, right? Okay, the risk is that you got 4 kids and you die and we need life insurance. That's a risk that we can mitigate. We can transfer that risk to an insurance company, right? By the way, you should have a big fat insurance policy, obviously. This is a risk we can't. I don't know. I feel like what happens? So let's push forward. It's 3 years from now, and the Fed's been raising rates and growth is this way and that way, blah, blah, blah. And let's just say that we got a refi and you're right, you're at that maximum level, but now it's 5 years from the term and now you got to refinance. And now instead of 4.5% or 5%, we're at 7%.
Well, Joe, can I ask you this? So one interesting thing, the one reason why I chose the Penn Fed, and I don't know if it was a good decision or not, but that's neither here nor there. The one reason I did choose that one is because it's their 5/5. So it will reset every 5 years, but then it obviously it locks and not locks, but it holds. So in other words, what I'm trying to say is that at the time of the reset in 2019, I would be at 4.75 maximum for another 5 years.
But then 5 years later, if you happen
I see what you're saying.
If you happen to be unlucky.
Oh, yeah.
That's the only thing that stinks. All right. I think you should talk to them. I think you should talk to them and see and shoot me a note and let me know how that turns out. Because I think we've got to at least consider these options.
Okay.
Maybe that isn't a terrible option. Maybe you and your wife sort of pinky swear and say, you know what, we're going to maybe even look at leaving this house. But even then, you're 4.75%, which is great for 5 years. In 5 years, if it's 9%, I don't know. I'm just nervous. And
I understand.
And the only other thing that makes me feel like a lot better about this whole conversation is you have the money to do this. In other words, you can afford the monthly hit. And most people who are in your situation can't. And that's the advantage you have right now, is that you could actually absorb a slightly, but let's say it's if you're paying $2,300 a month right now, if you had the whole mortgage and if I told you it's $3,000 a month, it's not so different than what you're doing right now. And I feel like if you were to fix this loan and then kind of see how your cash flow looks, then we could potentially start talking about 529 accounts. But until you fix this, I feel like putting money in that 529 is kind of dangerous, because if all of a sudden, things bounce higher and it's, a number of years later, you can't start using your 529 money to refinance your house in 10 years. So I think what I'm saying is this. I don't think there's no emergency, like the alarms are not blaring, but I think you have an opportunity, Matt, to go shop around, first go back to the originator, talk to other people, and let's think about fixing this while rates are still pretty affordable. Okay, that's a wrap of our Better Off bonus question of the week. If you've got a question, it's simple. Send us an email at askjill@betteroffpodcast.com. We'll arrange to get you on. And don't forget, in just a couple of days, there's a brand new episode of the Better Off Podcast, sponsored by Betterment. Talk to you then.